Hi there. My name is Joe Hahn, and I'm the Associate Dean for Graduate Programs here at the McCombs School of Business. As Associate Dean, I look after our MBA programs, including supporting our marketing and admissions for the program. So I thought for any of you that might be interested in pursuing an MBA, it could be helpful to perhaps look at how would one evaluate the value proposition of an MBA. I'm also a clinical professor of finance, so I regularly teach corporate finance and valuation courses. And so a secondary objective here is to show you a little bit about the financial concepts that you can use to build a spreadsheet to evaluate really any kind of investment, but the MBA is a great example. So what I'm going to do is switch over to my screen here and show you a template where I've got some basic assumptions put together. And then we'll build out a timeline and a financial model to do an incremental analysis of doing an MBA versus whatever else you might do with continuing your career. Then once we've done that, I will kind of show you some sensitivity analysis with that and also what some of the results actually mean. All right, so as promised, here is a little text box with what would be a typical word problem that you might have for any problem, but this is, again, particular to the problem of evaluating the value proposition of an MBA. If you take a minute to read this, you'll see that I'm first of all describing what is my projection of costs and income after tax with an MBA. And then because that's not relative to zero, that's relative to what would I continue doing. And that is my income without an MBA, income and costs and taxes and all of that. Then I have a section here of costs of getting your MBA and what all that entails. And then finally here, I have a discount rate that we're going to use here. Now, any of these inputs we can change, but in particular, we might vary the discount rate. It represents your cost of access to capital or to funds. And this can be either literal, so it would be your cost of borrowing if you were to finance something, but it could also be an opportunity. So in a setting in business, quite often we're evaluating a project relative to a separate project. If we're going to do this project, I have to forego the other project. So that in that sense, the discount rate represents a rate of return on that project that I'm not going to do. That is an opportunity cost. So either as a literal cost or an opportunity cost, we're going to use 6% here as our discount rate. Okay, so again, if you want to pause and read through that before we get started, that might be a good idea. So what I'm going to do now is I'm going to take some of these inputs and put them into cells that I can then use in my financial model. So there's our 6% discount rate. We're going to assume, and this is all per the words above, that my tuition for the program for the 2 years is about $100,000, rounded off. We're also going to have additional expenses of $30,000. That's relative to what we would have if we don't do an MBA. So these are extra expenses I would have as an MBA student outside of tuition. Then I have my, on the plus side, I have an internship that I can do during the summer between the first and second years of the program. And that typically an average salary for that's about $25,000. We can vary that if we need to. Then if I take on an MBA, the relevant parameters are here that I would take a signing bonus at the end of my second year of the program when I sign on of about $30,000. And then my starting salary during that first year would be $150,000, and it would grow thereafter due to pay raises every year, or about 7% per year. And I will be in a tax bracket of about 30%. If I do not do an MBA, I'm going to continue working at a salary. We're going to assume $90,000 per year there. So your bump here is $60,000 from doing an MBA. We'll vary that a little bit at the end. I'm not going to have quite the opportunity for advancement, so my pay raises will still be 5%. They're not zero, but they won't be the 7% that I'm modeling for an MBA trajectory. And then finally, just to be fair here, I'm gonna put myself in a little bit lower tax bracket if I decide not to do an MBA, because the future income numbers will be a little bit lower. That may be a bit conservative, but we're trying to be fair here in all respects and regards. So those are the basic inputs for this. The next step in creating a financial model would be to create the timeline. So what I have over here is a timeline in columns A and B. And what this shows is the first year of my MBA program has a beginning and an end. So that's period 0 to 1 is the first year of the MBA program. Year 2 of the MBA program will go from period 1 to 2. And so on. Here's year 3, goes from 2 to 3, and so on down to the end. And we're going to assume we work for 35 years after the MBA. So my very last 2 periods would be period 36 to 37, which is the 37th year of this timeline. All right, so that's how it works. And we'll do that both for an MBA and then without an MBA. And then we will take taxes out of the MBA salary and really just the salary, not the cost. And then same thing, we'll take taxes out of the no MBA option and then figure out what are the NPV and IRR. I'll explain what those are in just a second. All right, so let's start with our timeline here on the MBA side. So initially here at the very beginning, I'm going to put down half of my cost. So that is, I'm going to put the $100,000 here plus the 30 and then divide that by 2. That's half of my cost. Now the 30 is probably spread out over the year, but to be a little conservative here, I'm going to put it all at the very beginning. So divide that by 2. So you're going to put down $65,000, and we're going to assume you do that right at the very beginning of the program. All right, so after tax, unfortunately, you don't get any tax benefit for this. So your after tax number is what it is. That's $65,000. All right, then for the second year of my MBA, I'm going to put down the rest of my money here. So this would be the other half, again, of the 130, which is 100 plus the 30, and divide that by 2. And then I'm going to recognize, I have to decide where to recognize my MBA internship. I'm going to recognize that at the very beginning of my second year in the MBA program. So I'm going to add in there, add in the 25,000 there. So it offsets the cost a little bit, which is nice. And again, no real tax implications from that. So there we go. Now, in my first year of working, which would be year 3, after 2 years of the program, this is my first year of working, I'm going to recognize my income at the end of that year. All right, so here's my year of the MBA. Oh, actually, I forgot, I have to put in the signing bonus first. So I'm going to put that in at the end of the second year. So let's add that in. That is the 35. That's a little income you get right up front. So put that right at the end of your first year or the beginning of your third year. So we'll put that in, and that's probably not going to put you in a real high tax bracket, but I'm going to go ahead and tax it at the full amount anyway, so I can just copy it down when I get started. It's a bit conservative, but that's okay. So 30,000, and then I get to keep 1 minus 30%. I get to keep 70% of that after I pay taxes. So that is my number. And I want to just copy this on down. So I'm going to fix the tax rate here. That is, I'm going to put the dollar signs in or hit the F4 key, so that will never change from K30 as I copy down. All right, so there is my signing bonus. Now, here's your first year of working, year 3. So I'm going to recognize that income at the end of that year. So there is my first full year of MBA salary. That's that number right there. And then I'm just going to grow that every year at 7% per my inputs here. So I'll take the number above it each year, and I'll multiply by 1 plus my raise that I get for that year, on average about 7%. Again, I'm going to lock that number also so I can copy it down, put the dollar signs in front of the H and the 30. And then I can take that number and copy it all the way down. All right, lots of ways to copy. I'm going to do it the old-fashioned way. Copy here, and then I'm going to, so you can see what I'm doing here, paste it all the way down to the bottom as a formula. All right, so I'll just keep repeating that formula. And there's my income projection pre-tax. All right, and then this now is basically taking out 30% every year. I can just copy that down. So copy that all the way to the bottom. And this will be my post-tax. All right, so at this point, I can calculate what is the net present value and internal rate of return of an MBA. I'm going to do the IRR first, since we've already talked about what the discount rate is. So this would represent, again, my opportunity cost of either getting those funds or foregoing some other investment. So we're going to penalize our future cash flows at a 6% discount rate. And that means I have a preference for, given that I have an opportunity cost, I have a preference for having money now. If you offered me $100 now and $100 next year at 6%, I'll take the $100 now. You'd have to offer me $106 next year for me to be indifferent between 100 now and 106. So that's kind of what the 6% means, and it's going to discount or shrink those numbers in the future. In fact, more and more so as I go to the end of my timeline. I'll show you that in a second. So let's see what the rate of return is. What rate are we getting here? So you can do an IRR function in Excel, and you just put all the post-tax cash flows in there. And we'll see that our rate of return for an MBA is a healthy 58%. So that means that if you had to acquire the funds at 6%, either directly or through a lost opportunity, that is investing at 6%, this is returning 58%, given what you invest in the MBA. And that is more than enough to pay back the 6% or to offset the 6% opportunity that you could have had otherwise. All right, because of that, I know that this thing creates value. So the rule for an MBA, for an NPV, is that if it's positive, it's creating value. And I already know that based on the fact that this number here is quite a bit higher than that number there. But let's see how much bigger. This is in dollars now, not percent. So the NPV function in Excel will tell you this. I'm going to use the 6% as my discount rate. And it says it wants value 1 all the way to value 2, 3, all the way to the end. So I start here in the first period, and that's because it's in the future. And I go all the way to the end. And then I add in, because I do have some costs right now that don't need to be discounted. They go straight into the total here. Add that in outside of the NPV. And here is my NPV. It's $3.55 million. That is the net present value in today's dollars of all of your future income minus the cost of an MBA, which is quite a bit. So quite good numbers here. But that so far I'm just comparing basically to nothing, right? To no other alternative. I haven't done this yet. So this looks great. One more point before I do that. If I were to put 0 in for the discount rate, which meant I have nothing else to do with my capital, and it costs me nothing to invest in anything in the MBA included here. I'm going to put 0 in for my discount rate, and what I get here for the NPV is 14.4 million. And basically what this is saying is that's just the sum of all the numbers. I'm not discounting. I'm not having a preference for cash flows now versus later. By putting in a 6%, I'm penalizing the fact that I have to spend money now to make money later, and doing a fair analysis here. So at 6%, this is 3.55 million. All right, now let's do the other, because again, it's not relative to nothing. So if I continue working, I don't have anything today. I'm going to recognize that income at the end of my first year of working, just like I did with the MBA. But it starts right here. So that is my 90,000. Put that in, and then I'm going to grow that just like I did my MBA salary, but only at 5%. So I take this number and multiply it by 1 plus 5%. I lock that, and then I can copy that down. This will be just 0. Whoops. The same as this. There's no tax implications there, but here there is now. So I have some income, and I'm going to pay on that at 90,000 after tax. I will keep 75% of that, or 1 minus the 25% taxes that I pay. All right, I'll lock that as well so I can copy it down. All right, you'll notice here at the bottom I have a couple cells in gray, and what that's basically saying is even though this would be working 35 years from now, I'm going to give myself a couple of extra years of income and go ahead and retire at the same date as I would with an MBA, just to give the benefit of doubt, to give those 2 extra years of value to the not MBA route. So I'm being more than fair here with my timeline. All right, so let's do an NPV for this. NPV at 6% of my post-tax cash flow starting in period 1 to the end. And then even though I don't have anything happening in the present, I'm going to add it in as a good habit, just to have it there in case. So there you go. So my NPV without doing the MBA is $2 million about. So 3.5 minus this. So our incremental value here would be the difference between the two. This minus this, not 0. So I'm about $1.5 million better off with an MBA. Okay. All right, so that's an important number, and I'm going to now just verify that and show you a different way to calculate that, so which helps with intuition. By the way, there is no IRR for the no MBA route because I don't have any outflow. You can't calculate an IRR unless you have an outflow and then inflow back in, or vice versa. Here, all I have is inflow, and so this is NA. But that's okay. We'll do an incremental IRR here in a second. All right, so let's look at the incremental cash flows post-tax. So that is simply equal to what do I get after tax with an MBA minus what do I get after tax without an MBA. All right, so I'm $65,000 worse off the first year by doing an MBA. Then I'm going to copy that down, and I'll see pretty quickly that turns back in the other direction. So copy and paste this all the way down. And I can see here that after 3 years, then it starts to turn in the positive direction, and only more so as I go through time. So what is the NPV of the incremental cash flows? So let's check that. NPV at 6%. of all of my future cash flows, plus my outflow in the present, $65,000. And you'll see a familiar number there. So this is telling you that the incremental MBA, value of an MBA is a difference between the two NPVs, but it's also equal to the NPV of the difference in cash flows each year. So this gives us solid confidence that this is the right number. The IRR incrementally is the IRR of all the incremental cash flows. And that incremental IRR is 21%. Now I made a little plot over here to kind of show you graphically what all this means. So at a 6% discount rate assumed in our current model, you can see the difference here between the MBA in red and the not MBA in green. And that's that 3.5 versus about 2. So that's the difference at 6%. If your opportunity cost goes up, if you have better places to invest your funds, maybe I can earn 8, maybe 10%. That shrinks a little bit. So at 10%, here's the difference between the MBA and not MBA. And eventually I become indifferent between the two. If my opportunity cost becomes so good, and that value is, well, I calculated here, it's 21%. There it is on my chart here. It's about 21% where this crosses over. And so that means at any opportunity cost or cost of funding for getting funds, up until about 21%, you're better off with an MBA than without. After that point, it's really, there's a little bit of a difference, but it's not that big. So they're almost about the same. But at any point below this, in terms of your discount rate or your opportunity cost, you're better off with an MBA. All right, and I can see that if I go back over to my model and I play around with the discount rate cell. Here's 8%, and I see the here's 8%. I see the difference is the incremental value is about $1 million now. So that's the distance. That's the distance on the plot between here and here is about $1 million now. A little bit less, 960,000. And then that continues to shrink as the discount rate goes up to about 21%. So I go up to here, I make this 10%, still better off with an MBA, 15%, still better off on that, though now it's getting closer. And then when I get up to about 21%, now they're almost the same. And I know that from the incremental IRR. All right, so that is your sensitivity to discount rate. And again, 6 to 8% is probably a good representative opportunity cost for most folks. It's well below that 21%. All right, let's look before we leave here at a couple of other assumptions. So tuition is kind of what it is and other expenses, but what about an internship? What if I don't get an internship or I just don't want to do one? So I'm going to zero that out. And it really doesn't make a whole lot of difference in your lifetime present value of earnings. So while MBA internship is nice to have early on, it won't make a huge difference in your incremental value. How about a signing bonus? What if my signing bonus is only 20,000? Okay, again, not a huge difference there. What if I get 0 signing bonus? Still 1.5 better. In fact, let's run kind of a bear case here, if you will, or a pessimistic case. What if I'm making 100,000 right now and my MBA starting salary is only 140? So I'm below the mean starting salary for whatever reason. All right. So even in that case, so no signing bonus, I'm making 100,000 now and my starting salary is only 140 instead of 150. You're still $1 million better off in terms of your lifetime MBA present value. All right. So put our numbers back in here, go to our base case. All right, one more thing to check here. How about the salary growth here? So we're assuming about a 2, it's really the difference between these two numbers that matters. We're assuming about a 2% better average pay raise over the next 35 years of your working career. What if that gap narrows to a percent? So I could either increase this or lower that. I'm going to lower this to 6% on average. Again, you're still about $1 million of NPV better off here, even if you're only getting a 1% better pay raise in terms of your future projections. And again, the data suggests it would be a little bit more than that. So I think the takeaway from this over a pretty wide range of assumptions is that the MBA has a pretty good value proposition in terms of added value. Again, this is not incremental to 0. This assumes you could continue your careers as you're going right now, but the MBA, through the additional value that you get with your starting salary, the increased raise, even at a higher tax rate, it provides a lot of value. And that's over a broad range of assumptions, including over a broad range of assumptions about what your discount rate or your opportunity cost is. So I think that is about all I had for you now, but hopefully that helps you with your assessment. And I know there's ROI calculators out there on the net, but this allows you to build your own worksheet, start on some financial concepts and spreadsheet modeling, and then be able to play around with the spreadsheet and change some of the inputs and give yourself a good sense of what the value proposition of an MBA is. So I hope that's helpful and useful. And I also hope to see you around campus soon. Bye-bye. Hook 'em horns.